Okay, week 26, outlook number one. We are halfway through the calendar year for trading, or actually just halfway through the calendar year itself, week 26. So, just a little housekeeping. These videos, the market outlooks, are in no way intended to influence any, accounts, real life funds. These are strictly for educational purposes on reading price action from my perspective of the system that I've developed. And we're, I guess, effectively actively stress testing the system, refining it in real time as more data shows. And sometimes I might show a position or two that I'm in, but it's no way intended to influence anyone's trading whatsoever. These videos are for educational purposes. Now, with that being said, it's been a great year so far. Lots of improvement to make, lots of progress that has been made. But now it's time to step it up a notch, time to turn it on. So, starting with the British pound futures, let's go ahead and let's get right into this. We are still inside of the 4-hour macro perspective trading range. What we did last week was the trade played out in which we were actually counter trend, and we based the trade off of a area of interest. We had the response from the basically we played the response of the mitigation of this 4-hour area of interest, and that ended up leading to the run on the low here. And then I had the price gap that I wanted to see mitigated. It actually did get mitigated. We had a very short-lived response, and then price decided to go ahead and move towards taking out this liquidity point here. But something I noticed after doing a little bit more in-depth analysis is not only did we take out this low, but what's really interesting here is that we actually had equal lows here that I failed to see at the time. And so not only did we take out this low, but we actually cleared the real low, quote unquote real low, that was following this low up to this high down to this low here. And so because of that, the liquidity draw was actually not, yes, it was a liquidity draw, but the liquidity draw that was the most important, or the mitigation or the purge of liquidity that was most important, was actually the run on these equal lows, which is exactly what happened here. And because we got that run there, that also activated the liquidity draw model that I talked about multiple times. Now, and so what we have is bullish price action playing out. What something is to note is that this is a 98 to 99% retracement into the discount side of this range. So we are actually at a very pivotal point to see if the bullish price action holds or do the bears win out. And based on whatever scenario that plays out, there's actually 2 or 3 scenarios that I'm keeping in mind. We will assess the price action accordingly and move forward accordingly. But as of right now, if we're playing the immediate price action, we have a liquidity draw. And so we should be expecting for formation of price action to send price higher back towards the range, with the goal of swinging to hit these equal highs up here in the premium side of the range. If not, the second scenario is that we have a failure of this liquidity draw, the bears win over, and then we move back towards this low here. And so what happens here is, do we get a liquidity draw here, or do we get a break of structure? And if we get a break of structure, obviously we're looking to take out the low of the range, because that will be the last low standing on the discount side of the range. Now, what's also important to note here is that we do have an action of mitigation of this price gap here. But this price gap is not one that I would personally use for entry. It's not as conservative. This is just like the part of an action of mitigation. What I would like to see is, if this action of mitigation holds, we have a inefficiency object created following this action in order to frame up a trade. We need a little bit more conservatism, or we need a response that generates an inefficiency object in order for us to look for opportunities here for trading setups. Now, that being said, there's a little bit of conflicting analysis here for me, because I did look at the CFD charts and the futures charts. So we do have the liquidity draw model playing out. Now, on the CFD charts, this candle is actually pretty much full. And so this price gap that was mitigated which is another action and mitigation. In this case, I would not be looking for an entry, or I did not look for entry off of this. This is all just the pure price action waiting for price to show its hand, generating the liquidity needed in order to set up a valid or set up a trade based off of the model, is what I'm saying. And so anyway, we have this mitigate. Oh my God, this is horrible. All right, there we go. We have the mitigation here, and this is one of the only times I'm going to do this this year is using the CFD chart. This is still a valid setup. This actually is a price gap that has been validated. We 100% is actually down to the low here, and I'll actually show that here real quick. So this is what it looks like on the CFD chart in the exact same area. We see that we have this candle here. We see we have the price gap, and we came nowhere near the low of the range here. But since we're using the futures charts, we have to take into consideration that this actually is invalidated. But what we do have is we do have this low here that was generated. We have a high, we have a low. This low is generated, and then we can potentially call this, if we're reading this off of the futures chart here, this is a potential draw on liquidity, or a liquidity draw. So we do have another liquidity draw in which we could see price pulling back into this wick of some sorts, but I'm not going to read too deep into that. What I would rather read into is actually, in this particular case, using the CFD chart, the GBP Forex chart, GBP/USD Forex chart, and seeing this in this sense, where we have the price gap shown, we have the mitigation of the price gap, and then we have effectively a sponsor candle generated based off of the response from mitigation, the action and mitigation of this price gap. So we actually do have some sort of entry opportunity here if price does choose to return, and then it's up to whatever model plays out, or whatever model decided to play out, or price could just simply go higher. And this is based off of whatever scenario you subscribe to. So like I said, this is the only one of the times that I'm going to be doing that using the CFD chart this year. But as of right now, if we're looking at strictly the British pound futures chart, we have action mitigation, quote unquote, a liquidity draw here, but the liquidity draw model is in play. So all of this price action, if we can't make sense of it from the futures chart as of right now, then what we'll have to do is just wait for more price action to develop. I would not be surprised, because this does not really make sense to me looking at this as of right now, if we do get more consolidation to generate some sort of inefficiency object or liquidity in order to propel price higher. It's not important or imperative that price immediately begins the bullish price action just because we performed a liquidity draw. We still have to have some sort of structure formed in order to send price higher, especially if the price action doesn't make sense based off of the models that I use. But using the GBP USD chart, it is pretty clear that there is an opportunity inside of this wick relative to the candle shown on the GBP USD chart here. Okay, so that's a lot. Take your time with it, and we'll go from there. All right, so as far as gold, on the gold chart, we actually decided to break structure and then pull back very deeply into this area. And so what's interesting to me is that we are still inside of this bullish range. We are similarly testing the lows of the range, where we actually do have a break of structure of this low. We have a break of structure, or we have run on these relatively equal lows here, and we tested the we've basically created relatively equal lows with the structural point of the bullish range. So it's a very interesting time with gold. So I'm still going to wait to see what's happening. I'm gonna sit on the sidelines a little bit more until we get a little bit more clear, decisive price action. Are we going to break out of the range, or are we going to begin actually moving back towards equilibrium and into the premium side of the range? As of right now, this is just pure price action, and similar to what's happening on GU right now, it just doesn't make sense. It feels like we're just generating a bunch of liquidity to set up the real move. Now, if you're trading this, whatever, there could be opportunities with other models, but I don't see anything actively reliable for me to actually consider a trade or consider opportunities on gold right now. All right. So for the Nasdaq, similar scenario, right? We shifted our structural point. We are still in the bullish run phase of the market. All we did was shift our structural point because we performed a liquidity draw. We've generated relatively equal lows, so that's very interesting. That's a setup for potentially later, showing indication that price may want to pull back and run these lows. Then we'll have to decide, is this going to be a breaker structure or liquidity draw? And if it is, because this is our structural point, we most likely, depending on the scenario, if it's a breaker structure, we will transition phases from a bullish run into a bullish range, in which we'll have to identify where that the start of the bullish range actually is. But as of right now, what we do have following the outlook on week 25, outlooks is week 25, we did have an action mitigation here, and then we did have a run in which we created some sort of inefficient pricing, a price gap here for possible or for opportunities. But as we can see, this did actually get run, so it got invalidated, and then price is running higher. So right now, to me, the price action is not making sense for any of the models. So I'm sitting on the sidelines here waiting for a more decisive or price action that actually reflects the models that I'm looking to trade. Because right now, this is invalidated. There's nothing in this price action right now. There's no inefficiency objects. Everything's very efficient, actually, to trade. And there's nothing on the premium side, quote unquote premium side over here, other than potential highs. And so if we're looking at potential highs, that's just liquidity for targeting, but there are no active entry opportunities or models in play for me to play here. So getting rid of this, getting rid of this, getting rid of that. This is what we have set up, is we just have our structural point and then the pure price action, in which we'd be looking either to continue to take out this high, or we'll be looking for price to pull some sort of play in which we may perform a liquidity draw at these equal highs, or just have some sort of price action to run this low here. And if we run this low, that would be interesting, but don't want to forecast too much. All right, on to the Dow Jones. Very similar. We still have the bullish run here. We have solidified our price leg where we have the structural point in which we performed a liquidity draw. We ended up running this high, and then after we ran this high, because we have the highs and lows, the first low that got broken solidified the price leg here. And so what we're looking for is actually a pullback into the discount side to mitigate whatever inefficient pricing object or inefficiency exists for potential opportunities to move higher. Now, that is what the current analysis is. The other scenario is we have a complete basically change and we start moving towards this structural point. And the reason why I'm saying that is because actively looking at the charts here, there is no valid action and mitigation on the discount side of the market. This is a price gap, but this is not a valid price gap because it does not follow an action and mitigation. There is no action and mitigation here. There's no move to mitigate a sponsor candle or a price gap. This just exists. So if price were to come back and mitigate this, we would have to consider this the action and mitigation first, and then see for price to create an inefficiency object for trading to move higher. If not, what we could be seeing is something here on the premium side, which is this price gap here. But once again, if this would have to be the action mitigation, not the actual price gap to trade. And so as of right now, this is a valid action of mitigation, in which we have the mitigation of whatever this price gap is, and then we have a run higher. So because of that, any inefficiency that is generated following this would be an actual valid area of interest. And so immediately, of course, now I'm seeing this for the first time, is I do see this as a valid price gap. And we can see that this valid price gap was mitigated, 50% was mitigated. And so effectively this price gap is completely balanced in my eyes. And so this would be the opportunity for price to begin moving higher with the goal of targeting the continuation or goal of targeting this high here, but the immediate high would be this high here. All right, so we do have the active action mitigation, even though it's on the premium side of this price leg, this is where the action mitigation actually falls or plays out. So that's what we're seeing. This is what the model is showing. This is what the analysis is showing. So this is the opportunity. If you got it, great. If you didn't see it, like I didn't, cool. We'll just wait for price action to continue showing us what it wants to do. But the immediate target would be this high here. And then the ultimate target would be this high here. And then if this ends up failing, then we would be looking for price to pull back to perform action mitigation here. And then if it does generate an inefficiency object in the discount side following the action mitigation, then that will be opportunities for price or for us to get in to start moving higher yet again. All right. So those are scenarios for the Dow Jones. Now for oil. Oil finally, as expected, reached the target, which was this liquidity point here, which exists in the discount side of the range. So now it's just a matter of what does price want to do? So what we actually ended up getting was a break of structure. So because we have a break of structure, we should be assuming that price is going to continue lower. Now, I'm not analyzing oil for the sake of trading oil. This is more so just following the price action within a monthly range, right? So that's why I'm not going too deep into this. All I'm seeing here is that we broke structure, so now we should be either looking for price to continue lower towards this next low to see if there's anything there, or we could be immediately actually taking out this low, and if we perform a liquidity draw, we start moving higher. But I'm not really, looking at oil to trade anymore. To be completely honest, it's not really worth my time. I actually might stop looking at it moving forward. And the live cattle future is very similar situation. I think I've exhausted my playfulness looking at this chart. This is doing, things that it needs to do. I may delete this and start focusing more on the pairs that are actively in play and that I actually trade. All right, so I think I'm losing my voice here a little bit. That is week 26, outlook number 1. Peace.